Welcome back to the Daily Crypto Roundup, and first of all, Happy New Year to everyone listening. We're officially into 2026 now. Desks are starting to fill back up, traders are coming back online, and the market is beginning to show its hand after the holiday period. Today's episode is very much about getting up to speed, because we've got a full set of brand new stories breaking right as the year begins, and they give us a good early snapshot of how crypto is positioning into January. We'll run through what's moving the market today, explain why some prices are pulling back after the initial bounce, and then get into 10 fresh headlines that cover everything from supply events and exchange-traded products to regulation, adoption, and changing market structure. Some of this might not sound exciting at first glance, but it's the kind of groundwork that helps you make sense of the moves we're likely to see over the next few weeks. We're covering Ripple's scheduled escrow release and why the market watches it, the growing push behind exchange-traded products linked to Ripple's token, a major Robinhood New Year promotion that tells you a lot about how retail platforms think adoption really happens, Bitcoin's current stuck-in-a-range mood, and what that signals, Coinbase's own view of what will drive adoption in 2026, and then a big one that will affect a lot of listeners in the United Kingdom and beyond, new crypto tax reporting rules coming into force and what they really mean in practice. We'll also look at why some analysts think Bitcoin could outperform stocks and gold in 2026, and the growing debate about whether Bitcoin's famous 4-year cycle is breaking down. Quick reminder before we get into the stories. This Friday, we're doing the XRP giveaway. 2 people are getting 10 XRP each, and 2 people are getting 5 XRP. All you need to do is leave a comment on the episode. Tell us what you're watching in the market, what you think about today's stories, or what you expect from the first month of the year. We pick the winners directly from the comments, so make sure you're involved, and please give the show a 5-star rating. We are now only 42 ratings from our target. Alright, let's get into the stories. The first is a major supply event that crypto markets watch closely, even when people pretend they don't care. Ripple has begun, or is beginning, a scheduled release of roughly $1 billion worth of XRP from escrow as 2026 starts. Now, that headline can sound scary if you don't know the context, because unlock sounds like flood the market, and markets hate the idea of sudden extra supply. But here's what makes it more nuanced. Ripple's escrow system has been part of the project for years. The concept is simple. A large pool of tokens is locked up, and a set amount is released on a schedule. The release is transparent, it's expected, and in many prior months, Ripple has relocked a portion of what gets unlocked, rather than dumping it straight onto the market. That's why you'll hear 2 different reactions. One camp says these unlocks are basically a non-event because they're predictable and usually managed. The other camp says predictable doesn't mean irrelevant, because even if the market expects it, the timing can still affect short-term liquidity, especially when the market is thin and sentiment is jumpy. Why this matters right now is the calendar. Early January is when participation starts returning, when people reposition, and when narratives form fast. A big supply headline at the start of the year can become a magnet for traders, whether they're bullish or bearish, because it's a clean event to trade around. The sensible way to frame it is this. It is not automatically bullish or bearish, but it is a meaningful data point. It tells you something about potential available supply, it can influence short-term flows, and it can shape the conversation around XRP price action in the first week of the year. Story 2 stays in the Ripple ecosystem, and it's about exchange-traded funds linked to XRP, and the broader 2026 is the year institutions broaden out beyond Bitcoin and Ethereum narrative. There's a growing discussion, driven by market commentators and industry voices, that XRP-focused exchange-traded products could open the door to broader institutional participation in assets that are not Bitcoin. Now, the reason this matters is not that one product magically changes everything. The reason it matters is that exchange-traded products are a gateway for traditional money. For a lot of institutions, the biggest barrier to buying crypto is not belief. It's process, compliance, custody, mandates, product structure. Exchange-traded products reduce friction because they slot into existing systems. And once you normalize that for one asset, it becomes easier for more assets to follow. People's opinions here are split, and the split is worth understanding. Optimists say, if regulated products expand, it deepens liquidity, improves legitimacy, and encourages more allocation. Skeptics say, a product existing doesn't guarantee demand, and demand is what actually moves the needle. And both sides can be right. The key point for January is that traders will treat any credible exchange-traded product progress as a sentiment catalyst, because it signals the direction of travel. Crypto becoming more integrated, more structured, and more institution-friendly. Story 3 is a very different type of headline, but it tells you a lot about how platforms are trying to drive adoption at the start of the year. Robinhood has launched a New Year giveaway campaign that includes Bitcoin and other crypto rewards, along with high-end prizes, essentially using the classic promotion and rewards playbook to keep users engaged and pull new users in. Now, some people will roll their eyes at this, because giveaways can feel gimmicky. But the reason it matters is strategic. Retail platforms don't do this out of charity. They do it because their data shows it works. They know that rewards and incentives increase sign-ups, increase activity, and reduce churn. And in crypto especially, incentives are a powerful way to get people to try a product for the first time. The broader why it matters point is this. Retail participation is still a major engine in crypto. Institutions can set the tone, but retail activity often amplifies trends. When a mainstream platform pushes crypto campaigns at the start of a year, it's a signal that they expect renewed interest, and they want to capture it early. Let's pause here for a quick word from our sponsors. Stay with us. Next, we are going to look at Bitcoin itself, and the mood right now is best described as cautious consolidation. Reports describe Bitcoin trading in a tight range, basically stuck between key levels, with the market waiting for direction. This might sound boring, but it's one of the most important conditions to understand, because range-bound markets are where big moves are born. Here's why. When Bitcoin is in a tight range, you tend to get a buildup of positions. Traders place bets on breakouts. Others bet on reversals. Liquidity builds around key levels, and when a catalyst finally hits, you can get a move that's sharper than people expect because there are stop losses, leverage positions, and momentum traders all reacting at once. What people think about this depends on their bias. Bulls look at a range and say, this is accumulation, this is a base, this is the market absorbing supply. Bears look at the same range and say, this is weakness, demand is fading, the market can't push through resistance. The truth is, you don't know until you see the break, and more importantly, whether the market holds the move after the break. So what does this mean for January? It means the first 2 weeks of the year are likely to be about confirmation. If Bitcoin breaks higher and holds, that becomes a story. If it breaks lower and fails to recover, that becomes a story. And if it stays range-bound, that becomes a story too, because it suggests the market is still waiting on a bigger macro or regulatory signal. The next story takes us to Coinbase's view of 2026. And this is valuable because Coinbase sits close to both institutional and retail demand. Coinbase is pointing to 3 main drivers for adoption in 2026: exchange-traded funds, stablecoins, and tokenization. Let's translate those into plain English. Exchange-traded funds, we've already touched on. They're the bridge between traditional finance and crypto because they reduce friction for institutions. Stablecoins are digital dollars, or digital equivalents of fiat currencies, used for trading, payments, and cross-border transfers. Stablecoins are already one of the biggest real-world use cases in crypto because they move value globally, 24/7, often faster and cheaper than legacy systems. If stablecoin usage expands, it strengthens the infrastructure layer of the entire market. Tokenization is the idea of taking real-world assets, like bonds, funds, or commodities, and representing them as tokens on a blockchain so they can be traded and settled more efficiently. This is one of the biggest institutional narratives because it's about upgrading market plumbing. It's not exciting in a meme coin sense, but it's meaningful if it scales. Why Coinbase is highlighting these matters is because it signals what large, regulated players think adoption will be built on: products, payments infrastructure, and market efficiency, not just speculation. This next story is a serious one, and it's not just for traders. New crypto tax reporting rules are coming into force, linked to a global push to reduce tax evasion and increase transparency. The Financial Times has been highlighting how the crackdown on crypto tax evasion is tightening, and this is part of a broader international framework where exchanges and service providers will be required to report user activity to tax authorities. Now, the reason this matters is not to scare people. It's because it changes behavior. When reporting becomes automatic and cross-border, the "I'll deal with it later" approach becomes risky. And it also shifts the industry toward compliance as a default, which has mixed implications. Supporters of these rules say it's necessary for legitimacy. If crypto wants to be mainstream, it cannot be a blind spot for taxation. Critics say it can push users toward less regulated venues or create privacy concerns. Both points exist, but the direction is clear. Governments are integrating crypto into the same reporting expectations as traditional finance. And while we are at it, we should talk about the United Kingdom. Reporting suggests crypto investors are being forced to declare gains to revenue and customs under these evolving rules. In practice, this means if you're a UK listener, you should assume that crypto activity is becoming easier for tax authorities to track, especially when it touches regulated exchanges. Why it matters is simple. It removes uncertainty about the direction of enforcement. Whether someone agrees with it or not, the practical outcome is that crypto is being treated more like a standard taxable asset class. And for the average person, the takeaway is straightforward. Track your trades, keep records, understand gains and losses, and don't assume small activity is invisible. Story 8 is a broader reflection piece that has real sentiment impact. Bitcoin reportedly finished 2025 down on the year, and that matters because it challenges a popular assumption that Bitcoin always goes up over time in neat cycles. Now, to be clear, one down year doesn't break the long-term thesis, but it does matter psychologically. When an asset has a number-go-up reputation, a down year forces investors to ask harder questions. What's the macro environment? What's the adoption trend? What is the market actually pricing in? The debate here is interesting. Some people argue that Bitcoin's long-term trajectory is intact, but the market is becoming more sensitive to rates, liquidity, and geopolitical risk, meaning returns might be less smooth. Others argue that adoption is still early, and volatility is simply the price of being in a new asset class. The key point for January is that narratives reset at the start of a year. A down year creates a different emotional baseline. If Bitcoin starts January strong, it can quickly flip sentiment from cautious to optimistic. If it starts January weak, that can feed a new year, same problems narrative. That's why early January price action often feels more intense than it should. Story 9 comes from a research angle. A widely circulated view arguing there are several reasons Bitcoin could outperform stocks and gold in 2026. These kinds of pieces are important because they influence how people frame allocation decisions. You'll see arguments like potential changes in interest rate expectations, ongoing institutional integration, policy shifts, growing acceptance of Bitcoin as a treasury asset, and continued adoption. Now, it's important to be balanced. Research pieces are not prophecy. They are thesis building. Bulls will use these arguments as confirmation. Bears will dismiss them as narratives looking for a price chart. The correct approach is to treat them as scenarios. They tell you what the bullish case will be built on, and therefore, what data points will matter. If you want to know what markets will obsess over in 2026, look at what the bullish thesis says needs to happen. And finally, Story 10 is one of the more controversial statements making the rounds. The idea that Bitcoin is officially breaking its 4-year market cycle. This is a huge claim, because the 4-year cycle is almost a religion in crypto. Halving, then rally, then mania, then crash, then repeat. People love it because it gives them a story. So what does breaking the cycle mean? It means the market may be shifting from a clean, predictable pattern to something messier, more macro-driven, and more adoption-led. If institutions are involved, if exchange-traded products change the structure of flows, if crypto becomes integrated into mainstream portfolios, then the old cycle could blur. Instead of a neat boom and bust every 4 years, you could get longer periods of consolidation, more frequent but smaller rallies, and a market that behaves more like other risk assets. People's views are split. Traditional cycle believers say the halving still matters, supply still tightens, and human psychology still repeats. The cycle is breaking camp says structure changes behavior and the market is maturing, so patterns weaken. That's all the stories for today. Thanks for sticking with us through this holiday season. Drop your thoughts in the comments, smash like, follow, and as always, we will see you at the top.